Welcome. I'm Catherine Magana here with Rachel Ivanovich, Steve Wolf, and Greg Carroll, where we're here to provide you insights about the markets, financial planning and tax planning, and much more. Today is February 5th, 2026. What year am I in? 2026? I was out last week, so I'm thrown off a little bit. So just giving you a quick recap of where we're at as of yesterday's close, which was February 4th, 2026. The Dow Jones was actually up almost 3%. The NASDAQ down about 1.5%. The S&P 500 was up about 50 basis points or 0.54. And the Russell 2000 up 5.75. But that whole story will change today because the markets are down a little bit today. But looking at...
I'm almost surprised at those numbers anyway, because the software stocks and a lot of technology stocks, they're just getting wiped.
Yeah, they've had a pretty big meltdown the last few days, but they're not as down as much as it feels, but they definitely are down year to date. Looking at kind of some of the data that's coming out, the January job cuts that came out from Challenger, Gray, and Christmas surged to the highest level since 2009 at 108,435. So obviously that's been a big change over in January. And then looking at kind of where we're at with interest rates. So I was kind of taking a look to see where the probability of a change with interest rates for in March. The next meeting is not till March 18th. But the chance of no change is 77%, and a chance of easing is about 23%. So that's changed pretty much overnight, because yesterday it was in the 90s. So that was a big change overnight here. And then mortgage rates, they are slightly up, not too much, but the 30-year right now is 6.23, and the 15-year is at 5.59. So that was,
that kind of takes me to something here that you're talking about the jobs. The jobs are slowing down. The job market is definitely slowing down, yet inflation is kind of ticking up. So when we're talking about a new Fed chair, and I know that everyone wants him to the administration would like them to lower rates. I think that's going to be a tricky thing. We've got conflicting indices.
Yeah, because the two mandates are maintaining level prices and full employment. And you're right; they're kind of going in different directions that normally doesn't happen. So
we'll see. My opinion is I don't think you can lower rates. Put it this way: I don't think you should lower rates. Now, whether they will or not is an interesting question. But, even if they change the chairman of the Fed, which they will obviously do because a new one has been announced, he's only one vote in the committee. So his vote, he can lead, but it may not change anything.
Right. He doesn't make the ultimate decision. So there's, 12 voting members each time?
I'm not sure how many, but...
Yeah. So...
So speaking of rates, right now the 1-year CD is still at 3.75. That hasn't really changed, but the Treasuries, which they're about 3.52, so they're a little under favor versus CD rates.
Done much, and I don't have the figures. Maybe you do. Is the small cap index? Small cap index for about 5 years has just been so out of favor, and if you think about it, that doesn't make a lot of sense, because if you are a small company, you have a larger runway to grow. Yeah. Whereas if you're already a huge company, you would think that you don't have as much growth percentage-wise. So, you have a great...
Yeah, I think something that has a little bit to do with that is the fact that companies stay private much, much longer. I mean, look at one of the largest companies on the planet could go public later this year at like a $2 trillion valuation. When we started in the business, companies are going public at, 10 million, 50 million, 100 million.
Well, we were still using the abacus when we started.
Well, that was old school. But I think the fact that they're waiting so much longer because they're getting the funding they need without the public markets might be affecting part of that. And it depends on which small cap index you're looking at. The Russell 2000, it's like 40% of those companies are kind of like zombie companies. They don't make anything. They're not profitable. So,
well, that's what's interesting too, is if in the beginning of the year and maybe the end of last year, the non-profitable companies were the ones in the Russell Index were the ones that were doing well. But that switched. Now the companies that actually are making money are getting a better valuation, and that could set the stage for a good run for the Russell 2000.
Well, I agree with that. The interesting thing, the markets are getting beat up pretty badly today, but what do we look at when we're trying to decide? Are we supposed to sell stuff? We're supposed to stay the course? Do we add more money? And market breadth is one of the things you should always look at. And you can measure that with the S&P 500 index, which is a cap-weighted index where the bigger the company, the more influence it has on the movement, compared to an equal weight index where they all have the same dollar amount position-wise. So over the last 6 months or so, the equal weight has really started to overtake the S&P 500, which was really driven by what we call the Mag 7 and some of those really large companies. So that's a good sign. The small caps are another good sign that the broadening out of the stock market is really going to be helpful. So I think what we're kind of experiencing this week in the market is not something that people need to be afraid of. I mean, I did some calculations. I think the Nasdaq's off like barely 5% off its all-time high.
Yeah, but
Russell's 4%.
But that
S&P 2%.
That masks a lot of the issues. For instance, there was a company yesterday that came out with great results, hardware technology company, and they were down by something like 15%, and they're down by another 5% today.
Right. And that, again, that maybe these are some of those super large companies and they're moving the indexes a little bit, but if the underlying strength is there, that will prevent the market from having a washout where you're going down 10-15%. We're not going into a recession necessarily at this point. I think the market's pretty healthy overall.
And there are a lot of people who are talking about this is a bubble that's bursting and all that. The big difference between now and back in the early 2000s when you had the internet bubble is that these companies are actually making a lot of money.
A lot of money.
Okay. Now, the question of whether the software as a service companies will stay in because of the AI advancements, that is an issue that a lot of people are saying, well, all those companies are in trouble. I'm not convinced of that. I was listening to Jensen Huang, and who is the head of one of the biggest companies in the world, technology companies, and he was basically saying that doesn't make any sense. And he knows a lot more about this, I think, than I do.
Probably, just a little bit.
Most people know more than I do. So,
well, I think it's kind of interesting because we originally thought maybe the beginning part of the year we might see a little bit of a pullback or people selling off, but we didn't see that. And so seeing a little bit right now, I don't think it's uncommon for also some people to take some profits off.
I still feel like it's kind of like early January, but we're into February.
I know.
Right?
It's like, wait a minute.
January's gone. So
we've been talking too that these stocks had all become pretty expensive.
Yes.
So a correction here is not unusual.
It's probably healthy.
Mm-hmm.
It probably is. I know people are nervous about what AI is going to eat, as they're eating their lunch in different companies. But it seems to me that AI is more of a tool than anything else. And that's not to say there won't be companies that go out of business because of it.
Right.
But I think you're going to use that tool. I know we use the tool in our own business. I was trying to look for some preferred stocks about a week or two ago, and in the old days, it would have taken me weeks to do what I did in an hour because I could go on to ChatGPT and find the answers that I needed pretty quickly.
Yeah, it's very handy.
Yep.
I was listening to a deal. Anthropic is a company that apparently is disrupting a lot of these software companies because
it's not a public company.
And it's not a public company, but what's just I think the whole software industry is being affected because it can do not only simple tasks, but it can do very complex ones with very little inputs now. So financial analysis, it can do that and solve problems instead of going a lot of back and forth like ChatGPT. When you do that, I'm looking for this preferred stock, and then I want this, yield range or whatever. It's coming up with this stuff, apparently, a lot of information pretty quickly. So I think it's a disruptor.
Yeah, but the interesting thing is that they're still going to need all those chips. And matter of fact, that's the interesting thing that
chips are different than the software companies.
No, I understand that, but But everyone was saying, that the chip business is kind of passé right now, but it really isn't. All these companies are spending gazillions of dollars to buy more chips. Why are they doing that? Because they need that for the next generation of whatever it is that they're doing. So, I think we've got maybe a little bit of an overreaction in some of these stocks right now. But again, I think it's probably healthy, as you said.
Yeah, when things get expensive, I think a lot of fund managers, shoot first, ask questions later. When the valuations are that high, they don't wait around for why things are going down. They get rid of stuff pretty quickly at this level.
And on the downside, it always goes faster, and the reason is pretty simple. Not only do you have people selling the long positions that they have, but then you get short sellers in there. And for those people who don't know what short selling is, basically they're borrowing stock, they're selling it, and what they want it to do is go down and buy it back at a later date. Okay, so they're paying for that. They're paying a borrowing cost, but that
They're doing it in reverse: sell then buy.
Correct.
Yeah.
But it's still buy low, sell high. I'm sorry. Yeah, and this is just the opposite, where you're selling high and buying low.
Yep.
But you have to borrow the stock to do that.
Right.
All right. But that's why on the downside it always goes faster, because you have two different sets of people who are or investors who are selling that stock.
Yep.
So let's talk a little bit about some things that we've worked on this last week from like a financial planning and tax planning perspective. We've had a couple of conversations in the last couple of weeks. We've had a prospective client that her inherited a lot of assets of money, and now she's at a point where she's trying to make some decisions on what's next. But when you inherit money, if it's a non-spouse, meaning you inherit from a parent or a grandparent, there are still a lot of nuances and rules with taxes and when you have to take distributions. And if it's an inherited Roth IRA, if they were taking a requirement of distributions or not, and as well as were the accounts open for 5 years, and otherwise there's tax consequences. And so what we're finding is there's a lot of planning and nuances, and there's a lot more detail. It's not just, hey, I have this money and that's it. It's now looking at, okay, now that you have it, what's the plan, and what's and then for non-spouse, potentially you have to take money out within 10 years. So what's the best strategy for you with that?
The question would be, do I roll it into my own IRA or do I take it as inherited?
Yeah, and that was another situation. We had a woman that her husband passed away, and so she was going to inherit some money, and she didn't know, and she was working with an outside company, and they didn't really guide her. They were just saying, here are your options. And so we're just kind of, she doesn't know what's best, so we're now having those conversations. But once again, if you don't know, you make the wrong decision, it could really impact you.
Well, it's important also to take a pause right after it happens and meet with your trusted advisors and make sure that you're taking the time to actually come up with the best solution for you versus knee-jerk reaction and just making a decision without any guidance.
Well, and it's interesting. This same woman, there was a 403B account, and they're trying to tell her that, you have to take all the money out. And she's like, well, wait, hold on.
Don't do that.
Yeah, and I told her, put your break. I said, give me the plan document. Let me take a look at this with you. Because we had another client a couple years ago.
I've had a lot of these lately.
Yeah, but a couple years ago, we had a client, they came to us after the fact, and they end up taking money out because sometimes they don't know all their options when they take money out of retirement plans.
They got hit with massive taxes.
Yeah. And we were part of it after the fact. We're like, oh man, we wish we would have talked beforehand.
They just saw the big dollar signs. Said, I'm going to go do some spending.
Yeah.
But forgot about Uncle Sam's cut.
Yeah.
And Rachel always gets the tail end of that.
So make sure you ask before you take the distribution. Yes. So 69 more days of tax season.
All right.
Are you guys excited or what?
But who's counting?
Yeah, but a couple of issues that are coming up recently. So there were the fires in the Palisades in California about a year ago. And so now, of course, it's tax season and people are wondering, okay, well, I received money from my insurance company. I'm getting grants from the government. Is that money taxable or not? And what does that look like? And something that's a really interesting concept that you may not have ever heard of is a casualty gain. Everybody knows about a casualty loss. But have you heard of a casualty gain?
No.
That doesn't, it sounds like an oxymoron. Yeah.
Yeah, but think about it this way. So let's say you bought a house in the Palisades for $1 million, which still is, a lot of money, but then...
You can find a house for $1 million in Palisades?
In
I think it's a hypothetical.
This is a hypothetical.
Right.
Well, let's just say that they bought it in 1975 for $1 million.
There you go.
House burns down, it's worth $10 million. Guess what? if you get an insurance settlement for that amount, that's considered a taxable gain, because that insurance payout is considered sales proceeds. And so the difference between that $9 million would be considered taxable gain. So you need to be very careful, because there's some timelines in there if you do receive an insurance settlement to determine with a primary residence in general, if you reinvest the money into rebuild and you use all the proceeds to rebuild within a certain time period, you don't have to pay tax on it. But let's just say you say, you know what, I'm out of here. You sell the land and you move to another state and you say, I've got $10 million. I'm going to buy, a primary residence, but I'm also then going to buy, multiple rental properties, or I'm going to invest the rest of the money. There's a potential taxable situation there. So it's really important. But, I really haven't seen a lot of these in the past, but this year they're coming up.
Do you know what that time frame is?
It's 2 years typically. It's called an involuntary conversion. It's governed under Section 1033 of the tax code. A lot of people have heard of like-kind exchanges or the 1031 exchange, but so this is kind of in the same area of the tax code. It is called an involuntary conversion. But you have typically 2 years, but for federally declared disaster areas, you have 4 years. And unfortunately, what's happening, or what we're seeing, is sometimes the insurance payouts take more than a year or two, or maybe there's a lawsuit and then the money starts flowing in years later. Oh. So there's definitely a time, like there's a clock that starts after the first payout or that first event. So you just need to make sure you're...
Sounds like inheriting a Roth IRA. There's many nuances to this.
Yeah, so you definitely want to be working with your advisors.
Yeah. Of course, if you got $10 million and you decided to leave Palisades and move to Pittsburgh, Kansas, where I lived at one time, you could buy an awful lot of real estate there and still have a lot of money left for taxes.
But then you wouldn't get the 85-degree winter weather we had this week.
No, but you get tornadoes and you get snow and you get sleet,
Yeah, but I thought that was interesting, and this even could happen to somebody who was underinsured. So let's just say that you bought your house, 25 years ago, and your adjusted cost basis was, $100,000. You ended up getting an insurance settlement, which was not enough to rebuild the house to what you had before it burned down, but the settlement was more than what you originally paid for the house. That also can be considered a casualty.
So if you, in that situation, and you didn't have the money to supplement the insurance check to rebuild, you
could be taxed on that money if you don't use it to rebuild or replace.
Wow.
Yeah, it's tricky.
Dang.
Yeah. So
you wonder who
came up with this?
The tax laws and all the laws that we have.
You're looking at her right there.
every year it changes. It seems
I know.
there's always something.
I'm talking about the people who create these laws.
Yeah. Well, and honestly, it's really tricky too, because with these settlements, it depends on what the money's for. So for instance, if you receive money from your insurance company, it was for temporary living quarters. So for instance, you have to go live in a hotel or Airbnb. That's not taxable. If you receive money to replace personal property, oftentimes you have to replace your furniture and your clothing and so on. That's not taxable. But then the payments from the insurance company for the damage to your property could be taxable. It's just...
Yeah, where do you draw the line between your belongings
and
your house?
Well, it's considered personal versus real property. So...
You're right, Steve. There's some real geeky people sitting around figuring all these taxes out.
You have these. How big is the tax law? How if you
the code?
The books?
Oh, it's set on your yeah.
Probably from here to the moon.
Yes, something like that.
Well, especially when there's old code and new code and things. Some things get grandfathered and just.
It's tricky. Yeah. It's fun. I like it.
Does anything ever get grandmothered? I'm just curious about that. Everything gets grandfathered.
That's kind of sexist, huh?
It is.
Wow. I didn't even think about that.
Me neither.
I shouldn't have said that because the word police are going to be on that.
Well, I thought I'd share before we wrap up. We do have, through our Savvy Woman Wealth Management Division, we have a really exciting event coming up this month that Rachel and I are looking forward to. So we're having a workshop at the Carlsbad Chamber of Commerce here in Carlsbad. And we're doing something a little different. We're going to talk about core values, money mindset, and then we're actually going to do some vision
activities.
Boards. Yeah, so it's interactive, and so we're really looking forward to that. It's coming up on February 25th at 4:30. So if you're available or in here local, we'd love to have you come. Yeah, join us.
And if you have issues on things like inherited IRAs and all the things we've been talking about where there's tax issues, call us. We're not accountants, although I guess you were an accountant. Are you still considered an accountant,
Yes.
Rachel?
Yes.
Okay, so she is an accountant, but it's not really what we do for our living. But if you need help on that stuff, please call. I mean, that's why we're here. So, by the way, we didn't talk about the Fear and Greed Index, so I at least have to mention it.
Nice.
We're down back in the fear area. As a matter of fact, squarely in the fear area at 35, and the range is 25 to 45. Yeah, 25 to 45. And so we are square right in the middle of
It
fear.
seems
And that-
about right.
Yeah, and
Temperament.
It actually feels worse than
It
that, though.
does.
I thought we'd be in extreme fear, but not quite. So that's where we're at. We'll see where we'll be next week. Anything else as we go around here?
No, next week we do have a special guest. J.R. Phillips will be joining us to give us an update on real estate. So we're looking forward to that.
Great. All right. Well, until then, have a great week of investing. Happy investing, everyone, and we'll see you then.
Thanks.
Thanks.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.